This week in the Boardroom, brought to you by NYSE Governance Services Corporate Board Member, along with Governance Knowledge Partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of This Week in the Boardroom. I'm TK Kerstetter with NYSE Governance Services Corporate Board Member, and it's my pleasure to welcome you on what we think will be a very interesting topic, certainly a topic that's being discussed in every boardroom these days, and that is looking at the trends of executive compensation. And with me is one of our experts to help us get through this trend discussion. Welcome Bob Romanchek, who is the partner with Meridian Compensation Partners. Welcome, Bob.
Yeah, thank you, DK.
So I know that in your career you've been in probably over 1,000 compensation committee meetings. So we're going to tap this expertise. And what are those topics du jour that are coming up in your committee meetings today that our audience would need to know about?
Right. Yeah, thank you. So going into the busy year end of the executive compensation season, there are a number of things happening, as you would expect. Let me cover just a couple of the ancillary ones before I really get to the meat of the topic. First off, shareholder outreach. This is now expected. If you're not doing shareholder outreach on executive compensation issues, you really need to think about that. Whether your stock is performing great or not so great, it is something now that all big shareholder groups are actually formally staffing up and have great expectations that you're going to do that. Kind of take the middlemen out of that by the proxy advisory services, go right to your big shareholders. Years ago, everybody does shareholder outreach for business reasons. It's only been about the last 2 years that executive compensation now is a topic for those discussions. So again, that's an expected area going forward, and the prevalence that has just skyrocketed pretty significantly. Another big issue out there, which I'm going to talk a little bit more about, is simply adding performance to your long-term incentive programs. So if you are still doing things like making non-performance-based special or out of cycle retention type grants, you're going to have to rethink that. And regular cycle, clearly, to add more performance to that is going to help not only from governance and incentive, but also from some of the external advisors looking at that and really giving you higher grades for having performance. Of course, that leads into the proxy advisory services. Mid-late November, we are expecting those services to release the new rules for the coming calendar year. And there's some surprises I think we're going to see in that. A lot of discussions about what's going to be in there, typical type things. Yet beyond that, I do think we're going to see some new rules or at least thoughts and requirements pertaining to independence of outside directors. Lengthy terms might question some of that, and so there's been a lot of discussion on that. And also pledging. Last year, as you might recall, ISS in particular came out with some rules. Kind of the delivery at first was too stringent. They backed off a little bit and kind of tested the market on that. And frankly, because pledging, it's not a Dodd-Frank, it's not a statutory requirement, it is purely an advisory services requirement, pretty much everybody's ignored them. So I do think they're going to be more requiring on pledging going forward, and that's something to look forward. Not a lot of talk about that leading into the release of the rules, but I think that's something to look for. So those are kind of side issues. I think the big issues that people are paying a lot of attention to here, beside the pay for performance question, are the Dodd-Frank requirements. So we've got 4 issues in executive compensation that are still outstanding in Dodd-Frank related to executive compensation. Of course, the CEO pay ratio, which we can talk a lot about, a lot of discussion on that. But the next big one really is clawbacks. And clawback is different than the other 3 because this is actually a requirement. You have to put a policy in place, not simply make a disclosure. So it is much more requiring. It's complex. And I think no matter what the SEC is going to do when they eventually come out with rules, it's going to be controversial. There's not good answers in all the unanswered questions. However, I think the SEC is going to really take their time in coming out with these rules because of the complexity of the time required. And frankly, the market's complying. So the Fortune 100, if you look at those companies, over 90% of them now actually have clawback policies in place. Tremendous change from just 3, 4, 5 years ago when that was a single-digit prevalence. So the fact that the market is complying, they put in clawbacks, Those clawbacks are probably not perfectly compliant with eventual Dodd-Frank rules, yet good governance, and I think that has kind of taken the foot off the accelerator at the SEC with that one, again, given the complexity in those rules. The next one then is the pay for performance comparison disclosure. No one's really talking about that anymore, yet about 75% of big companies have already actually done calculations here in the realized or realizable pay calculation. So that's being done behind the scenes. Some companies are actually disclosing that voluntarily in the proxy, yet the actual chart or how that's going to look, there's not a lot of question yet on it. So those are some of the areas where we're seeing activity happening, and then including, like I said, the CEO pay ratio.
Bob, could you explain to our audience, make sure everybody understands what you mean when you say pledging?
Sure. And this often gets confused with anti-hedging. Sounds the same, but there is a significant difference. So actually the hedging or anti-hedging, that's the fourth and final executive compensation Dodd-Frank rule that we're waiting for. And interesting, the statute does not require you to have an anti-hedging policy. It simply requires you to disclose what you're doing. So, light of day will make everybody comply, and that essentially was happening. Many organizations either had anti-hedging policies in place as part of their Section 16 insider trading program without really realizing it's kind of boilerplate information, or the few that didn't, they're putting those in place, and you simply need to disclose what your policy is. Clearly, to come out and say you don't have an anti-hedging policy is not a good disclosure, so it's forcing everybody into complying and putting in anti-hedging. And hedging, very simply, is entering into option-type collar transactions, so you're locking in your gain on your equity grants. And that's the last thing you want with equity grants, to take interest out of those incentive grants so the executives no longer have risk of the stock going up or down. They lock the gains in. And that's what not only advisory groups, but shareholders don't really like that. So many organizations I mentioned have anti-hedging policies without even realizing it, never really had to enforce it. Yet now, because of this disclosure, which by the way is not yet effective until we get the rules, but you would think this was an easy one. Unlike CEO pay ratio or clawbacks, it simply requires you to disclose your policy. That doesn't sound too complicated, yet we still don't have those requirements out there. So that's hedging or anti-hedging. Pledging, very simply, is having stock in a brokerage account where you have the ability to margin or borrow against that. And you and I and anyone who has a brokerage account probably has a margin ability, yet whether we know it or use it or not, the proxy advisory firms last year came out and said, even if you have the ability to pledge shares, they were going to give you a no vote on say on pay. Quickly realized with all the feedback and criticism that they didn't realize just how significant the pledging is out there in the existence of these margin accounts. So ISS backed off in their final rule this time last year and simply said if you have material or significant pledging, that no longer is going to be a say on pay issue, it's going to be a governance issue. It will potentially impact the renomination of your outside directors. And they left it pretty high level, didn't really give a lot of detail on the definition of significant, but they also then went a little farther and explained they want every company to adopt a policy against allowing pledging. And you can imagine, why is this a big issue? Pledging has not been on the radar screen for many organizations or even proxy advisory firms until last year. A couple of famous cases out there where CEOs, large block of ownership interest, went out, borrowed against those shares, leveraged them up, and then invested in pretty risky investments that went bust. So what happens? Now they get a margin call and they have to sell their ownership, and it puts the board in a bad situation. So you can understand why that's probably not a good thing, particularly if it's significant, and that's what ISS in particular is kind of arguing against.
Yeah.
So the fact that this is not Dodd-Frank, it's not statutory, it very simply is an ISS requirement. This past year, everybody pretty well ignored them. And so prevalence did not shoot up like we saw these other three Dodd-Frank requirements. You think about the clawbacks, 90% of the Fortune 100 have those now. If you look at anti or pledging restrictions, maybe it's 5% have something. So I do expect when ISS comes out with their rules in late November here, that's one of the areas, as I mentioned, they're going to be a little bit more requiring because people didn't really jump on the bandwagon with that one.
Yeah. So what with the one of my least favorite things in the world, the CEO pay ratio disclosure.
Yes.
So what? There's still some things to sort out with this, but what should comp committees be doing today just to prepare for what's coming down the road.
Right, right. So it's kind of top level. Understanding what the CEO compensation is that you're plugging in this ratio is very easy. That's the far right column in the summary comp table. You're already computing that, so it would only take moments to really get that number. Actually creating the ratio is very easy. You're just comparing two numbers. There's a short required disclosure under the proposed regs. So most of this is pretty straightforward. The difficulty is the other piece, the pay of the median employee to create the comparison. That's where all the discussion, all the argument is. And as we know now, the 8 or 9 lines in the statute that describe the CEO pay ratio, it took the SEC 160 pages in their proposed regulations with 60 some unanswered questions that they asked for comments. So what should you be doing now? The final rules are not set. And I think, in my opinion, they're pretty far away. Although if you look at them, it appears that 2015 for calendar year end companies, 2015 is when you're going to have to start complying, meaning the proxy you file in early 2016 will be the first disclosure. I'm not so sure even that that's going to happen. And I don't want to knock people off from thinking about this, but there's a 60-day comment period. In my opinion, that's going to be extended. The thing about the number of comment letters that they got under Dodd-Frank in 2010, I mean, it was like 25,000 comment letters. Truly, a lot of those were form letters, yet just the volume. And in this particular issue, in this comment period, many are waiting to the end of the 60-day period to really get their thoughts together. So it seems impossible that the SEC is going to be able to work through all those comment letters, tweak the statute, and come out with something in time to implement any sooner than that. And frankly, the Chamber of Commerce has all but said they are probably going to file suit to attempt to vacate because the SEC probably didn't go through this administrative requirement of cost-benefit analysis, just like proxy access.
Right.
So, but to be clear here, this is law, it's statute, it's not going away. I can't imagine the administration and Congress, if they can't agree on anything, they're not going to agree to repeal an exec comp disclosure rule. So the law is there. It's just a question of when we're actually going to get rules that are effective. And I think that's going to be a longer time frame than everybody really thinks here. And I do think, I have hope that the SEC in coming out with their final release is going to be a little bit more favorable, ease up a little bit from the burden of trying to collect all the data to name the median employee. So with that backdrop, what do you do here? Well, seriously, I think companies should sit down and for the moment simply guess. Do some modeling. You can spend, I read something that some companies said they're going to spend $100 million doing this worldwide calculation. I think if you get the right couple people in a room in 20 minutes, you can come up with a reasonable guess just for modeling. That probably does not meet the statute, to give you an understanding of what your ratio is. And the scrutiny in the end is not going to come with people looking and arguing how you computed the median employee. I mean, within a relative range, again, you can probably guess what that's going to be to some degree. Those are going to have very high ratios. That's where the scrutiny is going to come, obviously. So what should you do? Model, think a little bit. If you can add some comments explaining how difficult this is and the burden of computing, that's what a lot are asking for. But I think you got to start getting a handle on it, but don't go overboard. Again, we don't know the final rules, and I do think they're going to change a little bit.
I can already see the newspaper articles with the headshots of the CEOs that have bad ratios, which is going to mean nothing,
Yes.
but it'll be a lightning rod for all those things. I'm just sorry that we're at the point that we are, but let's talk about more positive things. I know that Meridian, your firm, just released its 2013 Corporate Governance and Incentive Design Survey.
Right.
And we've got a couple minutes here, but can you share a couple things that were very interesting coming out of that, and then we'll let the audience know where they can get a full copy of that.
Sure. So this is a survey that Meridian conducts every year. So we do a year-to-year comparison that was just completed. It's 250 very large public companies, approximately the same 250 organizations, so we have a good year-to-year comparison. So a couple of issues, one in particular, long-term incentives. Obviously, that's where a lot of the action is. That's the biggest pay component for your top executives. Interesting developments here. So now if you look at these, over 90% of them have a performance type vehicle. So performance shares, performance units. The great preponderance of those are performance shares, not units. It's like 75%, almost 80%, and that is a change. So in other words, performance units, so those are just denoted arbitrarily cash units that don't change in value over typically a 3-year period and pay out in cash. When you denote those in shares, performance shares, and pay out in shares, you really create a double incentive. So not only do you have to hit the performance goal over a 3-year period to get a payout, the underlying shares change in value. And if you perform, arguably those shares should be worth more at the end of the 3-year period. And so I think that's an important factor why so many have switched to the performance shares. But bottom line here, performance shares are now the most popular vehicle by far. If you look at the other vehicles, there's just 2 other categories. So if you look at this group, so about 90% use performance type vehicles, mostly performance shares. 64% use stock options, which is amazing because all the talk out there is stock options are going away. And not only do I think not, it appears that given the economy, things kind of settling down, the market performing. If you go back historically over long periods of time, when the market performs, everybody switches to stock options. When it doesn't perform, there's uncertain, they switch to full value shares or performance type programs. So we're kind of in an interesting crossroad here. And the third piece of that puzzle then, full value shares, restricted stock units. If you look at that, it's 58% granted those from a prevalence perspective. So you can see stock options are actually a little more prevalent now than full value shares. And the interesting change, you go back to 2008 when the market fell out of bed and everybody moved to full value shares, couldn't predict performance, 3 years, no visibility, troubled financial services, mandated you had to use restricted stock. Those days are over. And you can see now it's the preponderance really is performance-based vehicles with performance shares, stock options. Some argue stock options are performance-based, others don't, some of the advisory firms, and then RSUs. So if you look at the weighting of this group, a little more than 50% of the value granted are performance shares, a little more than a quarter, 27% are stock options, and about 20% are full value restricted stock units. So that is a change. And on restricted stock is RSUs, not restricted stock. 2/3 of companies have switched to RSUs now because they're not proper into the tax code. You get some tax benefit of deferral not vesting or tax at vesting, and it solves some international registration and tax issues as well. So that's the first category, and very quickly, a quick observation. The second one, lead directors. So we have evolved here. If you look at the companies within this group that have a combined chairman of the board, CEO, over 95% of them now have a lead director, and virtually all of them pay the lead director. So what's happened now is that lead director really is looking like the independent outside director or independent chair that you lack if you've got the same executive being chairman of the board and CEO. And when this first started, that under Sarbanes, you had to have executive session. It was more of a figurehead who's going to run the meeting. This now has real duties, responsibilities, and thereby most of these organizations are compensating the lead director, and the compensation is very simple, similar to the retainer that they're providing to the audit chair.
So Bob, I know there's a lot of other things that are included in the survey, and I know that Meridian has done other surveys. Where would our audience get a copy of this?
So they can go to the Meridian website, and we'll provide that in the clip here in a moment. Certainly they can call me directly, or they can go to our iPad, which is free to anybody. You just get into the iTunes store, type in Meridian Compensation Partners, and that app will come up and load it for free. It only takes a couple seconds. That governance and the other surveys will be loaded on the iPad application.
Well, Bob Romanchek, thank you for joining us, and I know we only touched the surface of everything that we could in this compensation trends, but I know it'll be helpful to our audience. And that will conclude this edition of This Week in the Boardroom. We hope you enjoyed the show. We'll be back again next week when we take a look at another critical topic that'll help you be a better board member or committee member. So we'll see you then.
Join us again next week for This Week in the Boardroom, brought to you by NYSE Governance Services, Corporate Board Member, along with Governance Knowledge Partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.